Fed's favorite inflation gauge called PCE, specifically PCE Core. We have some comments from Fed President Bostic. I want to talk to you about the housing market from 1978 to 1996 because I think some of you are missing the subtle ways to get wealthy. But folks, let's get into it first. Let's talk about good old Tom Lee. Folks, if you don't know who Tom Lee is, I would call him the ultimate stock bull. He is often on CNBC, and frankly, we need to give Tom Lee his flowers. He has been right more than any other stock analyst this year. What is Tom Lee saying right now? Well, Tom Lee is out saying that, I want to make sure I have it right, the S&P 500 is going to erase the August lows and going to race to all-time highs this year. If you are a follower of this channel, you know we have a young man on Sundays named Dan Bird who has been telling us this for 6 months. 6 months. So Dan has been, I think, early as well. But again, why is Tom Lee saying this on CNBC? One, there are 4 reasons. 1, the economy is clearly cooling off. 2, the Fed won't hike again. You happen to know that I'm also in that camp. 3, investors were overly bearish about August. And then 4, historically speaking, a weak August leads to a good September. These are, of course, Tom Lee's thoughts. You can go ahead and check out his interviews on CNBC. But yes, folks, more and more people are coming out saying, hey, the Fed has done their job. The Fed is winning. The Fed will talk tough, but they will do nothing. It's kind of where I am at as well. But again, not stock advice. I'm just sharing with you what Tom Lee is saying. S&P 500 going to record highs this year. How about good old billionaire Jeff Green? Jeff Green, it does have an E on the end of it if you want to research him. Jeff Green with an E at the end. It's silent. He is someone who made about $800 million or so in the great real estate crash of, 08 to 11, 12. I'm not sure when he cashed in his chips, but he did call the bear market and, more importantly, profited from it. What is he saying today? Real estate investors should be on the lookout for a wave of distress to create opportunities. Retail, office, multifamily will all get whacked. We are in the first inning. He expects the next 12 to 24 months to create some amazing opportunities. Folks, what have I been telling you for 6 or 9 months? This is mathematically coming. Yes, the big boys will get their shot at the Class A stuff, but who cares? You and I will get the opportunity to pick up assets from folks who were financial engineers, not operators. The people who gambled, who got lucky, who played with momentum, they're going to get hurt. We, because we do the work, we know average, we only do good or great deals, we are going to be stepping in, we are going to be solving problems, and we are going to get some amazing deals. Now again, 12 to 24 months. However, you have to get ready. You have to build that discipline. You have to understand your market. You don't guess. This is not a time to guess. This is a time to do the work. Now again, remember Jeff Green is talking about big things. And as I've told you repeatedly, and I highlighted in my first book, One Rental at a Time, residential and commercial operate very differently. Commercial will extend and pretend. They will bleed for a year, but the pain will come. They don't do that on smaller stuff. If there's a problem with the operator or the asset or the keys get mailed in, opportunity is coming. Folks, the last 2 years, you have seen me be a very cautious and conservative investor. I did some deals, sure, but not nearly as many deals as I've done historically. That's because I only do great deals. It's coming. Do the work. Understand how to play with price and terms. Folks, not enough of you are geeking out with the spreadsheet that we build and how to get started one rental at a time. Take one of your properties in that spreadsheet today. That's a horrible deal. Play with price, play with terms, and understand how subtle tweaks can explode that yield higher. It's coming. It is coming. It is coming as like, dawn to dark or dusk to whatever it is, whatever that saying is. It's just coming. It has to. There's so much froth, so much dumb money, so much gambling that has to just go away, and the good operators who structure debt to hold for the long term win. That's the key. We don't get debt structures that blow up. We don't buy negative cash flow or alligators. We just continue to do the work day in and day out. PCE, we got to talk about it. It's the last inflation reading for July. It is the Fed's favorite inflation gauge. Again, the Fed is winning. The Fed is just winning. The Fed's going to stand pat. They're going to talk tough, all this other stuff, but they're done. Expectations for core were 4.2, came in at 4.2. Headline reading was 3 last month, came in at 3.3. More importantly, the month-on-month was 0.22. So if you annualize the last 3 months, you get 2.9. If you annualize the last 6 months, you get 3.4. And remember what I have been telling you for a year. 10 months. Shelter, which is 43% of CPI, starts to roll over next month. We are finally there where inflation, shelter inflation, 43% of CPI will roll over. Yes, gas is up, but I think gas makes up like 8 or 11% of CPI. Shelter collectively is 43%. Just feel that. It is going to get better the next 3, the next 4, the next 5 months. Shelter inflation has to roll over. That's how the math works. It's going to be fun. I think CPI comes out the 11th or 12th, something like that, so pay attention. Now we got to talk about the housing market from 1978 to 1996. You have seen me go over this in the last couple of days with Anna Kelly, I believe with Matt and Dion and the Three Amigos. I've done it a couple of times. But here's the deal. If you haven't gotten the free 53-year spreadsheet on my website, I don't know what you're doing. It's gobs of economic data for 53 years. All data is sourced. Go get it. All you need is your email, so the system automatically emails it to you. The point is, interest rates started going up in 1978. They went up for, I don't know, something like 8 or 9 years until they got down. That is higher for longer. The question is, what did interest rates do to the housing market? Both transactions and price. We're going to talk about both because I know lots of you care about price, although the crash we've had is in transactions. So let's do transactions first, just to get that out of the way. Transactions were 4.8 million total in 1978. It wasn't until 1996 that we did 4.9 million. The housing market was broken for 18 years. So all of you thinking that we're going to be back at this next year or the year after, it's not coming. It's going to take years. But now, let's talk about price. Let's talk about price. And we're going to talk about price in nominal and real. Remember, this channel is trying to educate you. Nominal is the number that's reported. However, if you adjust for inflation, do you get a different picture? The answer is heck yeah. So let's do it. From 1978 to 1996, and you can go get the spreadsheet and do the math if you want. Housing went up 110% in nominal terms. Folks, housing doubled from 1978 to 1996. The average yearly increase was 5.8%. Okay, Michael, that's nominal terms, but let's talk about real. I want to know the inflation adjusted. Good. I like it. Good job. Very different story. If you adjust for inflation from 1978 to 1996, that 18-year period, housing went up 11%. 11. That is only 0.6% a year. Now, some of you hear those numbers and you're like, Michael, see, I told you, housing is a terrible investment. You're an idiot. You're a moron. No, you're the idiot and the moron. I have a shirt that says, I use inflation to get rich. Ask me how. So here's the deal. It is true. Nominal increase in housing was 110%. Real was 11. That's 99% delta. But let me ask you a question. Your debt. Does your debt go up or down because of inflation in real terms? If you have a house at 100 grand, for easy math, and let's say it goes up 110%, you now have a house that's worth 210 grand. But your debt, because you put 10% down, is $90,000. You get to keep all the upside, and the debt stays the same. And, oh, by the way, if you're following what I follow, the debt is fixed. So all of the increase in rents, which I'm sure doubled or more, is yours to keep. Folks, some of you are saying, Michael, we are going to have a real housing crash in real nominal. You freaking don't get it. Who cares? The debt doesn't adjust. You get to keep the extra equity and you get to keep the extra cash and you get to pay off the debt in 30 years with cheaper dollars. What are you doing? Why are you arguing with me? You are arguing with me because you just are, I don't know, frustrated, mad, whatever. You're wrong. If you want to get wealthy, own assets. Specifically, own assets that cash flow day one, fixed rate debt, all the stuff that we talk about here. So again, if you bought a house in 1978 for 100 grand, in 1996 it's 210 grand. If you had 10% down, your debt was 90 grand. It's probably, I don't know, 62 grand now after debt pay down. You win. Cash flow in 1978 was $100. Cash flow in 1996 is $1,000. You win. Stop arguing the wrong story. Inflation is a feature, not a bug. I will say that again. Inflation is a feature, not a bug. Learn how to use it. You can again get all this data at onerentalatatime.com. Go ahead and get it. I'll need your email because the system, not me, the system will automatically email you the spreadsheet. And we got to thank John Sterling, who continually updates the spreadsheet for us. So John, if you're watching, thank you very much. I appreciate you. Now we get to talk about good old Fed President Bostic. Fed President Bostic, I believe he's out of the Atlanta Fed, if memory serves, but don't quote me on that. I think he's out of Atlanta. He is out on the wire saying rates are high enough. He says that if we were to take out the lagging indicator of housing, core CPI would be 2.6%. Who else has been telling you that? Underlying inflation may well be close to our target rate already. Shelter inflation is 43% of the inflation number. Folks, I believe the Fed is done. You've heard me say that for several weeks now. They're just on a glide path. They're going to continue to talk tough. They don't want the market. The market wants to hear cuts. My expectation is the Fed is done and they will not touch this for all of 2024. No cuts, no cuts, no cuts, no cuts. I don't want any cuts. Let's clear the bad debt. Let's clear the speculators. Let's have some pain. and let's just get going. Other numbers that came out this week, consumer spending was up 0.8%. Estimate was 0.7. Last was 0.6. Consumers are still spending. It's changing from stuff to services. Unemployment claims down again. 228. Expectations were 235. Last was 232. Job market's still strong. We do get the jobs number for tomorrow. The estimate, let's play a game. I like playing games, you know that. The estimates for non-farm payroll tomorrow are 170K. Do me a favor, if you want a shot at getting a Nailed It t-shirt, I think I still have some of those. If not, I'll buy you one. Take a guess. Leave your number below. Let's see who gets closest. And if you nail the number, I will send you a shirt. So again, the estimate is 170K. Last was 187. What am I going to guess? The first number that came to me, complete guess, 98,000. I'm going to pick a number significantly below expectations. I'm going to guess, I got to write that down because you guys are going to hold me accountable. Let me write it down. All right, I picked 98 grand. Go ahead and pick your number below. That would be great. And then finally, the boot camp. The boot camp is going to be an amazing event. I feel really, really good about it. The more that I dig in and plan, I know we are going to help people not only live, but the content we create is going to help people for years to come. If you feel stuck, if you're ready to get going, but you don't know what market, you don't know your buy box, you don't know the math, you want some questions. If you're into this and you have one or two, but you want to ask me questions, you are going to get now 11 weeks of time with me in a very, very small group to ask all of your questions. My intention in this boot camp is to bring one topic a meeting for 30 to 45 minutes and then open it up to questions. Everybody is not at the same place. I asked everybody who applied 5 questions, and it's obvious everybody's at different spots. So I am going to create now an 11-week journey because I like exceeding expectations. And we're going to take one topic, and then we'll do another one and another one. But you will be able to ask me questions. Not only do you get that, but you get access to all the content and courses I've created, which is like $800 in value all by itself. So again, if you want to join the boot camp, we've got 5 or 6 spots left. 5 or 6 left. 5 or 6 left. I'll put a link below. As always, if you have to put this on a credit card, don't you dare buy it. Nobody should pay interest, none of that stuff. Don't do it. If you don't have the money, watch the free content here. If you want to try me out, go buy the $47 buy box. You're good. But if you've got it and you want to be a part of this, buy the 10-week journey, which now is going to be 11 because we're going to have our day 0 next week. It's going to be fun. Alrighty, folks, I look forward to it. Have fun. Take care of yourself. Again, the Fed is smiling. The Fed is winning. And lastly, let's congratulate Brian. I almost forgot. Brian, congrats. I think the story is you got your triplex. So congratulations for getting a triplex. Love to hear the details someday. Keep doing the work, folks. Great deals are out there. Like Jeff Green, right? Yep, billionaire Jeff Green says, get ready for the opportunities. It's coming, folks. I like it. Take care. Bye.